Hello, I'm Neil Whelan, and welcome to the Wesleyan Podcast. In this week's edition, brought to you by Wesleyan Financial Services, we're talking about retirement and pensions for medics. Doing the actual talking will be Wesleyan Financial Services Head of Division Alec Collie and Regional Manager Wendy Baillie. A pair of them answer some of the most asked questions we get from medics, covering everything from changes to the NHS Pension Scheme to the big one, when can I retire? Before we start though, I need to remind you this podcast is for information only and doesn't provide financial advice. But if you do need to talk to someone about your finances, I'll be back at the end to tell you how you can get in touch with Wesleyan Financial Services. And with that, I'll hand you over to Wendy. And first up, Alec.
Hello, Wendy. It's great to speak to you again in our series of podcasts to help our customers. So this one's all about retirement. So can I start by asking, what does retirement mean in today's world to our clients?
So retirement, I guess, in today's world, it's all about people living longer, isn't it? And living longer and in better health. So rather than an ending, retirement is a new chapter in someone's life. And that means that people generally have much broader expectations on what they want to do with the rest of their lives. I think often it means that it's not a full stop from work. A lot of our clients take their foot off the gas a little and then they continue to work. So they maybe do a little bit of taking some pension benefits and continuing to work for, say, 5 or even 10 years towards the end of their working life. And I think that's really important to note that there's the flexibilities that are introduced recently by the NHS in almost all of the UK. Sorry, Northern Ireland, not you yet, but that does give our clients generally a bit more choice around how they want to take their pension benefits and how they want that to dovetail into their retirement.
And I know we've got a question about partial retirement later on in the podcast. So we'll chat about more about that later. So talk me through kind of 3 key changes to people's outlook on retirement in today's world.
Well, I think professionals, such as most of who our clients are, they're facing ever increasing demands and pressures in the workplace. The NHS is no stranger to that, and it just is getting more pressured, I think. And what that means is that most of our clients want to achieve a better work-life balance, and it's one of the key things that they really strive for. I think the next thing is around changes to pensions and the way that they're taxed. And that leads our clients to question whether it's worth continuing with their NHS pension or actually just to take the benefits early and be done with it. It seems sometimes to be a simpler choice, not necessarily the right choice, but sometimes it seems to be simpler. And finally, in retirement, what does that mean to you? It's a fantastic opportunity to take stock and reconfigure your life. To make the most of the opportunity of retirement, it's important to know what you want and how to achieve it. Start with the end in mind and then work out how you can get there and how soon you can get there.
So kind of in summary then, you're saying work-life balance, work out what's important to you in terms of work and life. And there's a lot more flexibilities now that the NHS have brought in terms of working more flexibly for our customers and the NHS Pension Scheme and how that kind of works as well. Second one is around taxation. And I know there was a big conversations, a number of years ago around taxation, but I know that we've got some good news later on in the podcast around taxation and making sure people understand the changes to annual allowance and lifetime allowance as well. And then finally, that taking stock, I think, is really important. Really kind of working out between you and your family, what is it you want out of your retirement and your retired life. So you've got a good number of years after you retire to spend all your money and enjoy what should be a good retirement. So lots to work through with somebody and work through in your own head. So I know, Wendy, you and your team and the teams across our United Kingdom speak to lots of customers, lots of clients on a day-to-day basis. In your experience, what challenges does someone face in planning for their retirement?
Well, Alec, I think it's not really a challenge if you plan and plan early enough, like anything in life. I think even clients listen to this. If you reached your late 50s, you can still do some good financial planning to help put towards having a really lovely retirement that you want. But generally, the earlier you start, the better and the easier, the less painful it is for you to do that planning. A few of the issues that we find for clients is that people generally don't stop to think and really consider what they want in retirement. What do you want? What do you want to spend your time doing? You'll suddenly go from having zero free time to having lots of free time. What are you going to do with that time? How much money are you going to need in order to be able to spend that time the way that you want it to be? And the sooner you start thinking about that, better. And going back to time, we know that our clients have very little time to do any research. The NHS scheme is a gold-plated pension scheme. It's one of the best pension schemes in the UK, and despite all the recent changes and moving over into different schemes, it still is one of the best schemes that you can be in. You're very, very lucky if you've got in there. But it can be complicated, and working through what it offers and all the different options that you have as a member is really, really important to spend time doing. There are lots of options when you retire around how you actually retire, when you can afford to retire, and what, as I said, that retirement looks like. So everybody is different. Just because your colleague down the corridor or in the next building has done it one way doesn't mean to say that that's the right way for you. Everybody has their own take on retirement, and what's right for you isn't necessarily right for everybody else. And we're also very conscious that you guys at home are always time poor. Work is really, really demanding. Our clients are very conscientious and loyal to the NHS and to your patients. And also that means that sometimes you're reluctant to retire because nobody's as good as you are, right, for those patients. Planning, I think, with your employer, with your GP practice and with your hospital department, that's really, really important, so that you make sure there's a proper handover for your patients and you're not stressed about all of that. Sometimes as well, when you're so busy in your head, full of your profession and full of your working life, it's really easy to neglect your finances. And it means that they tend to drive you rather than you driving them. And that means they're not really in good order. So it could be that you might have commitments to provide private education for children just at the right time when you're wanting to look at retirement. Or it might be that you've taken on a mortgage and that mortgage payment has gone up recently with interest rates, and you're now looking at extending that term, and that's going into your retirement. And generally you want to get rid of that before you start thinking about retirement. So there's lots of different factors that come into play around what challenges our clients do face when they start looking and planning for retirement.
And you made an interesting point in the previous question around it's not a full stop any longer. I think previously people think it's a full stop, but more and more of our clients, I know that they are taking partial retirement, or they're just taking less sessions, or they're working a bit less because they actually want to keep in. Mm-hmm. I can always remember this story with this customer that I had over in Glasgow who, when I first met him, he said, I'm definitely retiring at 55. Luckily, I've been with the society as long. I got to 55. Nope, not ready yet. Don't want to retire yet. I'm going to wait until 58. We're now at 58. Still don't want to retire because he's still young. Feels 58's young, but he still is really into his job and still wants, like you've just turned around and said, about still helping patients and still feels that he can make a difference. And he's now said, no, it's going to be nearer 60 now. So you can see that person's planning continues to change. I think what was really important was with that client is that he had the option to retire because he engaged with us soon enough. And the great thing was talking about his options and his affordability and being able to plan for that actually is really good, isn't it? In terms of providing the option to retire, not necessarily retiring, but making sure you've got the options there, and good financial planning can really do that.
I think it's one of the best things about this job is being able to help somebody do something sooner rather than later, or even understand that they have, as you said, the option to retire, but they don't need to. And it makes such a big difference to your mindset when you go into work, to know that you're there because you want to be and not there because you need the money. And one of the best things about the job is to see people maybe retiring at 55, 56, 57, when they had initially thought that they were having to work until 60 or 65, 67, and it just makes such a difference to be able to sit down and spend a little bit of time, little and often, around planning.
Having that choice absolutely lifts a lot of weight off your shoulders, I think. So, is so important. Okay, thanks for that, Wendy. So then, Wendy, what else do we need to consider then when you're thinking about someone's retirement planning?
I think, Alec, going back to what I said around starting with the end in mind, I mean, really look, and I know it's not the end, but it's the end of one chapter and the start of the next, and think of it that way. So have a think about, who are you actually going to spend your retirement with? What are you going to do with your time? Where do you want to spend it? Is this your forever home, or do you want 3 forever homes? When do you want to retire? Why? What's your motivator around retirement? Is it about spending more time doing stuff that you like, or is it about running away from the stress and the pressures of work? And also, how do you want to fund your lifestyle? Are you going to need lots of disposable income because you want to go 3 times around the world every 2 years? Or do you want to just live a simple life and sit at home and do lots of gardening? It's really important to think about what your lifestyle is going to look like. And I think that's what a good financial advisor can help you with. It's important to invest the time regularly. Every year, I think, for an hour, 1 hour each year, that's all it needs, making sure that your plans are on track. And once we can see what the plan is, we need to then convert that plan into numbers. So we have a brilliant piece of software that our advisors have access to called a cash flow. And that cash flow will help translate your plans into numbers and help you visualize financial planning on a page. And so for our clients, that demonstrates if you can retire, when you can retire, and how affordable that retirement is going to be. And also, if you catch that early enough, some well-structured and thought-through financial planning can and will help plug some of the gaps that everybody's got. Nobody's got a perfect financial plan. Everybody has gaps, and everybody has areas that need attention.
No, I think you're right. I think cash flow modelling and the forecasting tool we've got, really work hand in hand to make sure we plan those, clients having that amazing retirement, which we want to help clients to plan for. Excellent.
And they're really colourful as well, Alec. Lots of nice pictures in the cash flow, which for lots of people, it's one of the real advantages of being able to see their life in a picture.
Well, it's interesting you say that, because one of the things I say when I talk to advisors is, on a Saturday night, we don't sit on the couch, drinking a glass of wine, listening to the radio. We actually do it watching a film or watching television or whatever programme is on TV, because we're visual people. We react to pictures, don't we? And I think when you see, I think you're right, cash flow, does put things into numbers, puts into context. It lets you see what your numbers look like over a projected period of time, or about 30 odd years, doesn't it? It goes on for, so I think all of that really helps put a lot of the conversations that we have into a bit of context. So so I agree. I think cash flow modeler is definitely, since we've introduced that, is a great benefit to our clients. One of the really interesting questions we get, Wendy, when I speak to clients and listen to appointments is, when should I retire? What would you say to our customer when they ask you that?
Usually, Alec, I'll turn that back around and ask a client straight back, when do you want to retire? And generally people will say, well, yesterday. But I think that question is about when you have the option to retire. As we were talking about earlier, it's when can you make the choice? Because going to work because you want to, as we said, is much easier to take than going to work because you have to. So if the question is asking when can you draw on a pension, let's just look at some official facts and figures. So the answer generally for that is 55 for most people. And very shortly in 2028, the pension changes announced a few years ago means that minimum pension access age is going to move to 10 years prior to state pension age. And in straightforward terms, that means that it's going to move from 55 to 57. So currently you can access pensions from age 55. In a couple of years' time, you're not going to be able to access them until 57. Okay.
And that's your NHS and private pensions, is that right?
All pensions, all UK-based pensions. And bear in mind as well that for today's younger generations, it's very likely going to be state pension age is going to be 70, which means that 60 would then become the new normal for being able to access any pension benefits. Also bear in mind that although that's a minimum age that you can access pensions from, there are 3 schemes in the NHS pension, and each scheme has its own normal retirement age. So if you're in the 1995 scheme, the normal retirement age for accessing benefits there is age 60. If you're in the 2008 scheme, the normal retirement age for this one is age 65. And with the 2015 scheme, remember this is the one that everybody's been in since April 2022, normal pension age there is state pension age. So that's currently 66, 67, going up to 68 for most people. And that means that out with pensions, if you do want to retire, you can actually retire anytime you want, Alec, as long as you have enough resources to live on. There's always examples of clients saying that they're giving up the main job, not necessarily retiring, but changing career. Portfolio careers are a thing. And in the past, everyone thought, right, I'm going to have to work to age 60 or later. These days, it can be a very individual decision, and it can even be before age 57 or age 55, as long as you've got enough money, enough resources in other places out with pensions in order to be able to live your life.
And it's interesting with that, isn't it? Because a lot of customers, a lot of clients have said in the past that it's a penalty if you want to take your NHS pension sooner. It's a penalty, but it's not really what it is. You're actually getting your pension paid out quicker. So therefore, they do a clever calculation which looks at, basically it makes sure that you're getting your money quicker. So instead of getting 67, you're getting it at 60. So they need to make sure there's an adjustment in there to say, well, you're not being paid into the scheme, you're not going to be paying into the scheme, and also you're drawing the benefits out quicker. So we need to make a reduction in that pension. So there's no penalty.
No,
it's just
it's a reduction. Yeah. It means that if you live to the normal life expectancy, you'll come up with having been paid the same level of pension as somebody who did take their benefits at normal retirement age. It's just you've had yours longer, as you've said.
And minus a wee bit because of we're paying into it for the next 7 years, so they've lost a wee bit as well. So I think with good financial planning, and I think what I've seen is if you get your forecasts early, if you're sitting sitting listening in the car or at home just now, and you're thinking I'm 45 or I'm 40 and it's a bit too early to think about it. No, actually thinking about it now is really important.
Perfect timing.
Because you might want to put some more financial planning in place so that when if you do want to retire at 60, or certainly have the option to retire at 57 or 58 or 60 or whatever number might be, that you can afford to retire. And that's the whole point of it, isn't it? Is what you said, is that make sure that you have the option to retire and when you choose to, and actually starting that as soon as you possibly can, is what you need to do.
There is no point, Alec, in retiring and having lots of free time, which will be a new thing for all our clients, and not having the money to do anything with that free time. I can't imagine there's anything worse than being in that situation, and there's no need for it, just with a bit of planning.
And I think the other things that you probably need to think about is if you are a hospital doctor, for example, you might have some private practice income. So the question is, how can you extract out of that? If you're a GP, potentially you might own the practice. So again, what's your exit strategy out of your private income? Do you just, and go back to partial retirement and not having to, or just cutting down in hours? That's kind of what cash flow does. You talked about cash flow earlier. That's what cash flow does. It kind of puts all those scenarios in place to say, well, actually at 57, I can move from 9 sessions down to 7 sessions. I can supplement it with a wee bit of this and a wee bit of that to make sure that actually, from a family point of view, you get that balance in a good place. So
lots of facets to it.
Definitely an interesting part of financial planning. Okay. So Wendy, we talked a wee minute ago about taxation and the changes the government introduced following quite a lot of pressure, including from us as well as an organisation, because we've seen lifetime allowance and annual allowance, the impact that was having on the profession. Can you just kind of summarise what the kind of changes have been and kind of where we are now?
Okay, we're talking about lifetime allowance and annual allowance, so let's just separate them both out firstly, because it's quite easy to get confused between the two. So let's talk about what it is first. Lifetime allowance, that is the maximum amount that you can build up within your pensions over your lifetime. So not just NHS pensions, all pensions, without incurring a tax charge. Now, the lifetime allowance limit was removed from April 2023, and it will be abolished altogether in April 2024. So that's the lifetime allowance. Maybe it doesn't matter, you're thinking, well, maybe not, maybe so. Let's just think about it for a second. Annual allowance. Annual allowance is different, and annual allowance is the maximum amount that can be contributed to money purchase pensions and the value of benefits that can be built up in defined benefit pensions in any tax year without incurring a tax charge. So what that means is that if you've got a pot of money pension, it's the most that you can put into that pot of money in any 1 year. Now, we all know that the NHS pension isn't a pot of money pension, it's a promise of income for the rest of your life once you get to retirement. And so for the NHS pension, it's nothing to do with what you put in there, it's to do with the increase in the value of your benefits between 1 year to next. Okay, now the UK government increased the maximum amount of annual allowance to £60,000 from 2023, so that's really good news as a result of pressures, partly because of the NHS pension and the issues that it was causing everybody. It is important to remember that the tax treatment depends on your individual circumstances, and also that we're not in charge of tax. Sadly, we are not in charge of tax. The UK government are, so they can make changes, and it's really important to stay on top of those changes. So the increase in annual allowance combined with something called CPI changes, they just realigned the impact of inflation on your NHS growth projections. That means it will help a lot of our doctors avoid any additional tax liabilities going forward. Just remember that if you're on the higher earning spectrum, then the annual allowance can be reduced depending on your earnings. So if your total earnings are over 200,000, then you need to understand the impact that this might have on how much your pension can grow before you would be subject to tax charges.
And that was the thing before around taper allowance, but the taper allowance limit was a lot lower before. They've now increased that, but it still does affect a small proportion of doctors in the UK. So we need to be very aware that it still exists and it's still there.
Especially if you've got dual income, Alec, and they're both pensionable. It can really impact you.
Positively, lifetime allowance after April 2024, formally within the budget, will disappear. That does limit your lump sum though to the over 268,000, doesn't it? But
yes, it does.
Overall, though, abolishing lifetime allowance will be a big benefit to a lot of our medical clients. So that's a real positive.
It means you can maximise income from your pension going forward, and it means there's not going to be such a significant drop between earnings and pension income.
And I know that, you know, for many years when lifetime allowance limits were coming down and down, clients who had invested in a personal pension maybe 10 or 15 or 20 years ago were finding it more and more difficult to take money out of that pension or the personal pension now. It gives a lot more options now. If you've got an old pension scheme, you know, lying in a bottom drawer somewhere, you know, you've now got options with that now that lifetime allowance has been taken away.
Absolutely. Before you would have paid through the nose with tax because you would probably have breached the lifetime allowance with your NHS pension benefits. And it meant that a lot of our clients were really struggling to know what to do with an old pension pot. Whereas now, it's just the tax-free cash that's going to be the limit going forward. And it means that you can maximise your income from the NHS side of your pension provision, and you can then maximise your lump sum from potentially the personal pension side. There's lots of different things that you can now do.
Yeah, and a good thing actually though about even just leaving the lump sum as it is, or leaving the personal pension as it is, it's good from an inheritance tax point of view. So, but that's for another day and probably another.
That's another podcast, Alec.
I think there's one point in what you just said, Wendy, about the changes to the scheme. You know, when the 1995 scheme has an automatic lump sum, and the 2008 and the 2015 scheme doesn't have an automatic lump sum, and there's therefore a lot of our doctors will have to make choices now, won't they, in terms of retirement? And you said before around, you know, the removal of lifetime allowance does actually give a bit more choice around maximising income. I know that when I've spoken to doctors in the past, a lot of doctors use their NHS lump sum to either pay off mortgages or pay off debts or fund, a big purchase. I mean, can you talk through, the kind of considerations you might need to think about around, if you're in the 2008 or the 2015 scheme, and more all customers now are in the 2015 scheme, aren't they, because of the changes? And that's going to really impact younger doctors.
It is, because I think when you've had a 30 or 40-year career and you've had an income at a certain level throughout your whole career, with the best will in the world, it's still going to be a step down when you retire and you stop earning, and you then have to be able to live on the pension income. And so it can be quite difficult for people to adjust. And that's why it's really nice to be able to maximise the income, if possible, that you can get from your NHS pension. But this, of course, does mean that more and more, as we have clients coming through who have been more and more in the 2015 or the 2008 scheme and not in the 95 scheme, it means that there is less and less availability of tax-free cash from the NHS pension itself. And that means you need to start thinking earlier in life about, right, how am I going to fund this second home, car replacement, helping my kids on the property ladder, paying off my own mortgage. Lots of the clients actually take out borrowing later in life because they want to help their kids onto the property ladder, and they aim to then pay off the new borrowing with their pension lump sum. That's not going to be something that you can automatically count on doing going forward. You need to be able to do some planning around, okay, so how much lump sum do I need? How does that impact my income? Is that acceptable to me? Am I going to be able to live on that? If not, what else can I do in order to build up alternative lump sums that are just as tax efficient or as tax efficient as possible, so that I can still do all of those things but still take as much income as I can get from the NHS pension.
And then go back to the income part of it, because you have to be really mindful that if you're going to reduce your guaranteed income for life, bear in mind that doctors statistically live longer. If you're going to give up some of your guaranteed income for life, you have to be really, really sure that is the right option for you. And I think, again, going back to cash flow modelling and the forecasting tools that we've got, that essential expenditure, which is covering your bills and your utilities and your food, and this is your living, that's your essential monthly outgoings. And then you've got a lifestyle expenditure about, well, let's understand what that lifestyle that you want to lead, and you've got a lifestyle expenditure, and then you've got spare expenditure on top of that. We just have to kind of work all that through, don't we? And that's where we do have to take a bit of a step back, sit down, have a really good think about what that income in numbers really looks like, so that you can work this through.
And sometimes that's painful, Alec, but it's absolutely always worthwhile spending the time to do it.
I don't think
I've never had a client who said that they weren't glad that they'd done it.
No, and I can even remember doing it even just with my brother-in-law when we were talking about his retirement planning. And he felt it painful for the first 5 minutes, but 2.5 hours later we were still chatting through what his retirement plans were, because he'd never really sat down and properly thought that through and thought through what his retirement goals are. I suppose the last question from me is why choose Wesleyan? Why should a client come to us?
Well, I think that we are here for our clients right through their whole working lifetime and beyond. And what we have are specialist financial advisors, and they have detailed knowledge around your specific profession and around the NHS pension. And so your local advisor is very well placed to guide you through the process of retirement, both extricating yourself from the NHS and also any other vehicles that you've got to help fund your retirement. We were really, really proud to launch our retirement club over the past couple of years, and it's a club specifically for our clients which talks about all things retirement. So as a retirement club member, you've got access not only to help, support, guidance and advice from your local specialist financial advisor, but also there's an online hub which provides a whole host of information around the NHS pension, retirement options, alternative funding for retirement, life after retirement and everything in between. Retirement Club members also have access to exclusive on-demand webinars and podcasts like this one, all with a focus around retirement. So there's a wealth of information at your fingertips that's there whenever you have that burning question that you might want answered, whether that's at 3 o'clock in the morning or 3 o'clock in the afternoon. It's all there for you to use.
And I think, we're always here for our clients, whether and what has always impressed me as well is I've been with the Society for over 12 years now. It's an organisation which, I very much choose to work for, because they treat me really well as a member of staff, as an employee, and we try and pass that over to our customers and our clients. And it always really impresses me the amount of financial advisors who've been here for, it feels decades. Decades, and actually we're retiring now with our clients, which is lovely. I don't think you get that in many other organisations or certainly financial advice firms. So having that longevity, that kind of, that even if a financial advisor leaves, we always then replace into that a local person back into that area, don't we? So we have over 250 advisors across the UK serving our 3 or 4 key professions. So we should never forget our heritage is really, really strong in terms of giving that longevity advice, that lifelong partner advice to our customers. So Wendy, again, thanks so much for your time and answering the questions as thoroughly as you have. If there was one or two key things you would leave the listeners to go away with today, what would they be?
I think, Alec, it would be going back to something I said right at the beginning, and that is please start with the end in mind. And what that means is that you need to plan. Planning doesn't take an awful lot of time as long as you start planning early. And I don't mind who you use to help you to plan. It can be Wesleyan. We'll always welcome you here whenever you need to speak to us, but it can be with whoever advisor you have a connection with. Just go speak to them, go talk to them. That's what they're there for, and use them to help and guide you around your plan for retirement. And then when you get there, it will be just exactly as you wanted it to be.
Wendy, really sage advice. Thank you again, and I'm sure I'll catch you on our next Wesleyan podcast.
Thanks, Alec. Bye.
And that's our show for this week. Thank you to Alec and Wendy. If you are looking for expert financial advice, especially around pensions and retirement, go to wesleyan.co.uk, where you can book a no-obligation appointment with one of our specialist financial advisors. There you'll also find links to our retirement club, which is a dedicated resource helping you plan ahead for your dream retirement. As for finding out about Wesleyan more generally, you can find us on Twitter or X, and Facebook, Instagram, and of course LinkedIn. And if you found the podcast useful, you can like and subscribe to us on all the usual platforms, as well as on YouTube, where there's a whole library of videos covering a wide range of financial planning topics. But that's it for now. So until next time, thanks for listening.